investment banker. I've been doing it for about 13 years. As a matter of fact, I own my own investment bank. I used to work for Goldman Sachs, where I started my career at a very young age. And eventually I just felt that I could make better money. Being on my own, with a couple of my partners, we put together funds, created and structured a company in a way that we can handle our own money and manage other people's money. Got to the point that we're almost around the market for 4 years, and it's good. It's good. The company that I founded is called the Soriano Group. The Soriano Group, I'm not longer the CEO of the company, but I'd rather be the chairman of the board. So I precede the meetings for all managerial decisions that take place in the company, simply because it gives me more access to other markets, and because of regulation, and I'm going to explain how these actually affects investment banking today, it just makes more sense. My information is here. This is the website. You have a Twitter account where I send out tweets about different things of macroeconomics. I cover the US economy, I cover Asia, and I also cover Europe. Our YouTube channel, it's the Soriano GRP. Soriano Group has access to all these different interviews. There are about 3 different channels, news channels, that interview me on a weekly basis to hear my opinion on a given topic. I would suggest that you guys stay abreast of everything that is happening today by reading newspapers or magazines that kind of break down what's happening with the economy. There's tons of information that is being sent out to us on a daily basis. What I want you to guys grasp in this classroom is how to clean up that information. How to read numbers and understand what these numbers are. Do they make any sense? Who is talking about this and why are they saying this? From an analytical point of view, in order to understand investment banks or investment banking, we need to understand the history of it. And this is why this class is all about the origins of investment banking. We refer to it as IB. The US capital markets is composed of 2 main components. And I'm going to just draw out 2 pillars so that we can discuss this more in terms of symbology. We are discussing ownership in a company. So that translates into ownership of a company. We could be talking about private companies as well as public companies. Right now, let's focus on just thinking that the markets are perfect and that they're all privately owned. You own your company, she owns her company, nobody else. The second instrument that we use in US capital markets is debt. Debt is also understood as fixed income. And that is used or also understood as bonds. Every country in the world has a central bank, a central government that governs monetary policy and fiscal policy. And based on these policies, the markets themselves get regulated. I'm going to focus on how the US regulation has affected the way investment banks today work to the way they used to work in the very beginning. And that's by going through the timeline of federal regulation. And we're going to take this and I'm going to bring you back to the future and going back to the past to understand how things have changed. Let's first kind of talk a little bit about these markets. Let's say that we start a company today, company X. Now there are many ways of starting a company. You can use your own money, if you have it. We can all have a brilliant idea about a new company, a new frontier, right? And we see this happening in our lives today. For all the companies that we shop or we consume from, there's always a new idea. For those of you guys that are into technology, we understand that technology changes every year, right? And if it doesn't, we are always disappointed, right? We always need something better, faster, smaller, less, heavier, and whatnot. We're always looking for this. So let's say that you have the idea and you have no money. How do you go about raising money? You look for investors. No, so we're defining words now. So we look for investors. Now, what defines an investor? What makes you want to spend money or put money into somebody else's idea? Of 1792. The story says and goes, and this is based on academia information, that 24 merchants and bankers got together and they said to themselves, and they signed an agreement that was known as the Buttonwood Agreement. The Buttonwood was a tree that was located down on Wall Street. So this was the birth of Wall Street. These 24 merchants said to each other, we all have different investments, which is what we call securities today. When you own any type of either equity or debt instrument in a company, you own a security, right? It's an investment. They all had investments in different companies. So I'm going to make a very quick, broad example that each one of you guys had a security in a different company. So you went to your friend and you said, why don't we create a system where we can exchange securities? The value of mine, you may want a piece of my company and I want a piece of your company. And this was the beginning of exchanging of securities with this small group of people. That eventually led into the creation of the New York Stock Exchange, which was established in 1817, almost 20 years after that, a little bit over. Until the markets went through a series of industrial revolutions that if we study in history we learn. And something happened right around the 1920s, right here. In the 1920s, things just got out of whack. And excuse the way I say it, but they did. People just went nuts, right? Exchanging securities. And this is all in the private sector. This is nothing, and it has nothing to do with the government. At that point, the government just took a look and they noticed that the government needed to step in order to maintain fair and orderly markets, because they knew that if anything such as the Great Depression that took place in the 1920s would have happened again, that it could have demolished our economy. But wait a second. It did happen again. Very recently, in our lifetime, in our generation. 2008, February. Sub-mortgage prime crisis, right? It did happen again. But let's go back in time, because sometimes we have to look at time to understand where we are now and how we can act in the future. In the 1920s, the government had not done anything until the election of FDR. This is what made Roosevelt so famous. Because Roosevelt said, there is no way that the government should not be involved should this take place again in our history, in our economy. He comes in, they enacted 1933, the first federal regulation to oversee the exchange of securities in the markets. People that are not educated would tell you that 1933 was the beginning of investment banking. But you know now that it goes back to the Buttonwood Agreement, and you can quote me on that. You have no idea what you're talking about. But this is the truth from a federal regulation point of view, because this is when the government got involved overseeing
how things work.
That was the creation. In 1939, the NSDA, the NASD, the creation of the NASD was to regulate what we know as the OTC. The OTC stands for over the counter. The exchange of securities do not happen in exchanges like the New York Stock Exchange of NASDAQ, but they take place in what we call over the counter, or OTC. So make sure that you make that distinction. In addition to this, in 1939, there was an act known as the Maloney Act, which created the MSRB. This is basically the act that covers and regulates anything that is done within municipalities, local governments. So whenever New York City wants to raise money from its investors, whether it's local or domestics or international, they need to offer you something, right? So the building of a bridge, the building of a hospital, the building of schools requires money. So New York City will sell bonds, municipal bonds. These bonds, or this type of debt instruments, as you know, have a loan effect. They're asking for your money as a loan in return for some sort of an interest. If you get involved with that, then the Maloney Act would be what protects you. And that was born in 1939, 1940. In 1939, there was also the Trust Indenture Act. The Trust Indenture Act, the word indenture means agreement, contract. That there needed to be an agreement between the clients, the investment bank and the investor, the client. And that's known as a trust indenture. If you don't have anything, then we have an issue. There was another act, and that one is called the Investment Company Act. Company CO Act. And what that act covers is that any time a company is soliciting for money, that the company should be able to offer you enough information about it so that you can make an investment decision. Plain as that. So if I have a startup company should have a business plan. This is in a way roughly what they offer you as information. If it's a company that is already in the market, public, then they should have all of their filings with the SEC that you can look at now, today, online. Plus, they should give you whatever other information that is internal and they think is relevant to you to have in order to make an investment decision. If you don't have this information, you cannot make an assessment on the company, you should not invest. If you go onto FINRA's website, they give you tons of different sites, direction, links, and assessments on how to protect yourself from investments that are not good ones. Because we see this happen, right? Scandals, fraud, and so on happening all the time. So how do you protect yourself? Is by learning more about how to go about learning how to make better decisions with your investments. In the 70s, we have what is called SIPA. SIPA creates an industry-based insurance. This is what we know, and this is what we call it: an industry-based insurance for investors. 1974 and 1975, we have, and I'll have to just make this line here, ERISA, which is the act that protects investors for all types of retirement funds. The most known in the US for all of you guys that work for private companies or public companies, the famous 401k. In 1980, an act called Insider Trading Protection Act. A lot of insider trading was happening. What happens is, when you are dealing in this environment, you are not the only person involved in this deal. There are attorneys, lawyers, accountants, portfolio managers, economists, publishers, and so on, right? So, who of these people are actually considered investment bankers would be whoever deals directly with clients and manages funds from these clients. And not only that, in order to be able to do that, you need to be registered. So say you're talking to your lawyer or you're talking to the accountant of a company, and that accountant happens by mistake tell you how much the company is making or how much money the company is spending, how they're leveraging out their expenses. You just obtain insider information that you shouldn't have, because that's usually very confidential. That person can get in a lot of trouble, but you're an investment banker, takes advantage of that information, sells it to investors. You make money with it, and if somebody tracks you down, you're in trouble.
If you invest after, like person invest with your money, are you in trouble?
Yes.
How can they understand that?
Well, they'll see a significant amount. What happens when you get insider information? There's already a set standard behavior how people are investing in the company, right? So I can measure the investments based on the fluctuation, but one day it just shoots out. That's a flag. That's a red flag. What happened? How come this person took that position? How come this group of people took that position? And that group of people are all connected somewhere. And if they all happen to be 10 people, and those 10 people happen to be my client, and I also did this, then there's something that nobody else knows. Right, so that's when the SEC and FINRA will come in and investigate and audit you. And the penalties are very severe these days. They're $5 million minimum, and they go up to 20 years in jail to life. Right? A good and famous case that happened was Bernie Madoff.